Assalamu alaikum, everyone. My name is Talal Tabbaa. I'm the co-founder and COO of Jibrel. So Jibrel is a blockchain development company that we set up in Switzerland around 3 years ago. And the concept is to tokenize financial assets. So this is a buzzword that's often used and not really described, or what do we mean by saying the tokenization of financial assets? So the way that we look at it is you had cryptocurrencies come about 11 years ago with some amazing transactional properties, which is easy to send and receive, 24/7, and most importantly, programmatic. You can embed specific logic into this digital asset in ways that's not possible for traditional financial assets. Yet at the same time, crypto has huge disadvantages or blocking points that make it difficult for mainstream adoption. And that is they're not regulated, they're not insured, and the value is not very stable. So what the tokenization of assets means is taking the transactional properties of cryptocurrency and the stability and regulation of a traditional financial asset. So it is the representation of traditional financial assets in the form of tokens. So when we first started the company, we said, all right, what do you need in order to do that? You need a wallet to store your digital assets. So we created the J wallet. But one very, very important thing is the creation of what's known as stablecoins. A stablecoin is simply a fiat representation, a token that represents fiat. So can I see a show of hands? Who here knows what a smart contract is? Okay, great. So there's most people know. So smart contracts is a way to automate a lot of business processes. However, there was one very big disadvantage of smart contracts several years ago, which is the payout or the output of the smart contract is in the Ethereum currency. And as we all know, we saw the AML presentation before us, banks are not ready to use such cryptocurrencies. So what we did is we got a US dollar or a pound or a Swiss franc, which is held in a client money account, and then we represented that in a token format that has the same transaction properties as Ethereum, but it's not the Ethereum currency. It's actually backed by a dollar. So you hear the argument of what are cryptocurrencies backed by? And that is a whole different subject, but what we do at Jibrel is we tokenize financial assets. So about a year ago, we did the world's first sukuk transaction with Al Hilal Bank, regulated in ADGM, where we automated the profit payments of a sukuk. But we quickly realized that debt debt capital markets is not really a good use case for blockchain, because that would mean that the bank and everyone involved would need to have transparency around the information, around the spreads, and that's not something that banks want. So since then, we've focused all our efforts on, or most of our efforts on launching our financing platform. And the idea of the financing platform is that it links startups and investors. From one side, you have startups raising capital, and then from the other side, you have investors looking for exposure to the venture industry. But historically, there's been a trade-off. Historically, there's been a trade-off between velocity of capital and investor protection. If you offer a lot of investor protection, you end up with an archaic, slow system. Just think of Dubai financial markets. If you want to go buy stocks on Dubai financial markets, you have to go to DWTC, sign some paperwork, loads of folders, scan your ID, wait in line, and then after 5 years, you can maybe open an account and start trading. This is not something that promotes velocity of capital, yet it provides very good investor protection. Think of something, so this is basically where we stand today. If you want to invest in a startup, if you want to invest in stocks, the process is very manual. You have to go sign physical documents, and that's something that should not be acceptable in 2020. So you end up with low velocity of capital and good investor protection. The other extreme is initial coin offerings, which are basically offerings of utility tokens, not securities. And then you could invest within a couple of minutes, and the process would be done fully online. It's very fast, yet it offers little to no investor protection, which is obviously an issue. So what we do at Jibrel is we improve both outcomes. We improve investor protection through legally enforceable digital securities, and then we improve the velocity of capital by having a technology-enabled investing process. So what do we mean by technologically enabled investing? We basically have an end-to-end digital investment journey that makes the mechanics of investing a lot easier. You submit your passport online, proof of address. We conduct what's known as a liveness test to make sure that this is not a stolen ID or similar. So you go through the full AML process, and then after that, you can browse the different investment opportunities and invest basically without having to physically sign a document or visit a branch. This is the more important part, I'd say. Investing online is something that has been there for years and years, and we'll just see more of that. What is really important is legally enforceable digital equities, or securities in general. So earlier I said we tokenize financial assets. But really, the value of a tokenized asset is worthless if you can't guarantee that the underlying asset is still there, right? You've heard of saying, okay, we'll tokenize this building or this hotel, and we can democratize it so that 1 million people holds actual ownership. Theoretically possible, but what if the owner of the hotel goes to the Dubai Land Department and sells the hotel? You end up with a token that's not backed up by anything. So what we've successfully done at ADGM is tokens that are issued from our platform are legal securities, meaning it's as if you hold your share. So what does this mean? What does this mean for the different stakeholders, for the different types of entities involved? So for investors, you can invest alongside leading VCs. You can have inclusive ticket sizes and reduce information asymmetry. So this is the advantage for investors. For VCs, they can improve their liquidity through the platform. Also, they can rebalance their portfolio towards the end of their fund timeline. And then for the ecosystem, you can streamline the securitization processes and then increase velocity of capital through the funding platform. And then for regulators, this is very important because you can track transactions in real time, and that will lead to reduced overhead. And then finally, the automation of compliance. The way that compliance is done today, in reference to the AML presentation before me, it's extremely manual. And at best, it's manual and it's inefficient. Let's say that. If you think of how central banks control capital adequacy ratio, it's done by self-reporting. Every bank has to send the central bank a report saying, hey, this is basically where I stand. And then if they are in a penalty or if they're in violation, the central bank fines them in retrospect. So the way we approach regulations is extremely reactive. We believe that there is a much better way of doing it, and that's by embedding regulations into the digital assets. This might sound a bit theoretical or far-fetched, but this is actually something that happens in real life. If you try to access one of the digital assets on the Jibrel platform, you couldn't open it from an IP address in Iran, for example, because it's a sanctioned country. The same can be applied to basically any type of regulation. You can automate the enforcement of that. What does this mean for the startups? What does our platform mean for startups? It means you can raise capital at a fraction of the time and cost, have a global reach, and scalable corporate governance. So this is how the platform looks like. You can browse the different opportunities. We have primary and secondary offerings. If you like a startup, you go through the deal terms. This includes overview of the company, what problem they solve, their value proposition, the opportunity, business model. It's basically a data room that includes all the information you need to make an informed investment decision. Also includes the team. Let's say you like the startup, you go through the necessary risk disclosures, and then you click on invest, you sign the agreement, you select your amount, and you check out. It should be as easy as e-commerce. And then the other element that we're also implementing as part of the platform, since these assets are tokenized, you can exchange them peer-to-peer without having to go through a centralized exchange. And that's quite important because currently lockup periods in the venture industry are up to 10 years for some VC funds. So basically this is what we're up to at Jibrel, and we believe that there's huge potential in the Middle East for such a platform because over 60% of the GCC's wealth actually sits outside the region. And that's mainly searching for investments with potentially higher returns But if you had a look at venture investments in the Middle East in the past 5 years, there's been a lot of successes, whether it's Kareem, Namshi, Souq, and we believe that the venture industry in the Middle East is just starting out, and we're excited to launch this platform and happy to hear and answer any questions.
Is a legitimate source. With this kind of documentation, investor has nothing to submit on the platform. He can just put up his money from his bank account and that's it.
No. So this is for a user that had already completed KYC AML checks. So what I just showed you is for an investor that already completed the process. So once you apply, you submit your passport, your proof of address, and then depending on the amount you want to invest, there's different KYC AML requirements. So let's say you wanted to invest. As a platform, we're regulated, which means we have to comply with ADGM's AML guidelines. So if you tell me that you're a gold trader and you want to invest $10 million, obviously a big red flag. But let's say you're a partner at PwC in financial services and you want to invest $10,000 in a startup, considered lower risk. So basically the compliance team at our company makes sure that any investor or investment are compliant to ADGM AML guidelines.
But don't you think digital profiles can be impersonated very easily?
Not really. Actually, not at all. If you think about it, biggest ways of fraud are actually manual. Cash, checks. For digital identity, especially in the UAE, I think it's quite low risk. Everyone has an Emirates ID. If you're a local, you use your Emirates ID or passport. If you're a foreigner, you submit your passport and visa copy. There's a centralized system for anyone residing in the country. So from that side, I don't think it's
But actually, we are removing the personal visit to the branch to making it to a digital site. So you lack the relationship with the investors personally, which bank does not lack. So bank has a proper history of their transaction throughout the banking channel. But here what we face is the AML guidelines and the KYC that they have completed 1 month back might not be relevant when he's investing after 1 month again. So are you collecting the AML guide, you're complying with AML guidelines on each step of investment, or it's just like a periodical thing that you do on a periodic basis?
Lala, that's a good question. So first of all, we only accept payments from regulated banks or regulated payment processors. So technically, any client of ours is already banking in the UAE. That doesn't mean we also don't do our own AML checks. But to answer your question, a visit to the branch is something that traditionally has been associated with identity verification. But actually, it is not the most efficient way of doing it. Today, there's something called the liveness check, which compares the image of a submitted ID versus the camera of your phone, or your laptop. It compares your image versus the image of the one submitted online, and providers such as Onfido, Jumio, these are world-class providers that, for example, I don't know if you've seen Revolut or Monzo, they each have over 6 million clients. That's probably more than any bank in this country, or probably in the Middle East, and they've been able to successfully verify their investors using digital means. This technology is still early, to be honest. So in our case, there's always an AML officer that reviews the case as a whole and then makes a decision whether, in some instances, if someone is investing a large amount of money, we could request for a personal interview. So to answer your question, we depend on the banks because we're receiving money only from licensed financial institutions. We don't accept deposits ourselves, and we do our own AML checks. Great. Any questions?
Any questions? how do you go about valuations? And this is the most critical things that, from my experience, founders are very sensitive to valuations and the whole negotiation process. How does it happen?
Okay, I'll give two answers. The answers of Talal presenting and my actual honest answer. The honest answer of how people do valuations is, especially for startups, like you say, okay, it's a 3 million cap or 5 million cap, 20% discount. Really, startups don't have the revenue, the traction, or the balance sheet to come up with a proper valuation. This would work for larger sized deals, but anything that's pre-revenue, pre-product, or even in up to Series A in the region, it is very random, if I may say. So that's why at Jibrel we've decided to get out of this conversation in general. We are a co-investor. We never lead investments. So for a startup to be on Jibrel, we need to have a VC or a professional investor leading their round. Meaning, let's say I have a startup and I want to raise $2 million. I go to a VC in the Middle East and I convince them of the worthiness of my investment. They invest $500,000 and they dictate that it is at a $3 million valuation and I'm offering common shares. What we do at Jibrel is we fill up, we co-invest. So we don't go into this discussion because that also has a different type of fiduciary requirement. We stop acting as a platform and become more active, and that's not something that we're planning to do anytime soon. So really, we piggy bank off the due diligence and and it's not only due diligence. It's because a VC could tell you, yeah, I think it's worth 4 million, but if you're not investing at that valuation, talk is cheap. So in our case, we only do where there's a VC or someone leading the round.